The global energy landscape is undergoing a seismic transformation, and one of the clearest signs of this shift is China's sharp reduction in its imports of US crude oil. Data shows a dramatic 46% decline, with volumes dropping from 150.6 million barrels in 2023 to just 81.9 million in 2024. This plunge has caused China to fall from the second largest buyer of US crude to the sixth. But this isn't just about numbers, it's a glimpse into a much larger story about how China is rethinking its energy strategy and reshaping global oil trade in the process. Now you might wonder, what's behind this sudden change? For years, China, as the world's largest oil importer and one of its top consumers, has relied on a wide network of suppliers to fuel its energy needs. But recent developments have pushed the country to shift gears. The COVID-19 pandemic, for example, brought lockdowns that curbed demand, while high domestic stockpiles and refinery upgrades further reduced the need for imports. Still, these are just surface-level factors. At its core, China is actively looking for cheaper and more flexible options to secure its energy supply, moving away from reliance on Western sources. And where is China turning for these new sources? Well, this is where things get even more interesting. Countries like Russia, Iran and Venezuela are stepping in to fill the gap. Their share of China's seaborne oil imports has risen from 24% to 26%. A seemingly small percentage increase, but a massive shift in absolute terms when you consider China's enormous daily imports of over 10 million barrels. Russia, for example, has been offering significant discounts on its Urals crude due to Western sanctions, making it an irresistible option for cost-conscious Chinese refiners. Meanwhile, Iran continues to supply oil to China despite US sanctions, using tactics like turning off tracking systems and conducting ship-to-ship transfers to disguise the oil's origins. Venezuela, too, has found ways to sell its crude to China at bargain prices, using complex payment systems and intermediaries to navigate US restrictions. All these discounted sources are doing more than just filling the void left by reduced Western shipments. They're also deepening China's ties with nations that are often sidelined by Western policies. This isn't just an economic decision, it's a strategic one. By diversifying its suppliers, China is boosting its energy security, reducing its dependency on any single source, and shielding itself from geopolitical shocks. It's also forging stronger relationships with countries like Russia, Iran, and Venezuela, which are eager for new customers to counterbalance the effects of sanctions. This approach not only enhances China's global influence, but also underscores its willingness to operate independently of US-dominated trade systems. Of course, moving oil under sanctions isn't straightforward. Analysts tracking these flows have uncovered a web of strategies designed to mask the origins of shipments, such as disabling tracking systems and conducting ship-to-ship transfers near Malaysia. Sometimes Iranian or Venezuelan oil is rebranded as originating from Malaysia or Oman, adding another layer of complexity. Yet the steady rise in these imports suggests that China is playing a calculated game, leveraging these pricing gaps to its advantage. Even a slight shift in where its oil comes from translates to billions of dollars saved and major changes in global trade routes. And the ripple effects don't stop there. Traditional suppliers like Saudi Arabia, Angola and Brazil are feeling the pressure. They're being forced to adjust their prices to remain competitive in a market that's being reshaped by China's evolving strategy. This isn't just about numbers or barrels, it's about a new balance of power in the oil market. China's move away from US crude and toward discounted suppliers is more than just a shift in trade. It's a bold statement about its priorities and its vision for the future, both economically and geopolitically. As this story unfolds, it's clear that the global energy map is being redrawn, one shipment at a time. China's evolving energy strategies are sending ripples through global markets, challenging traditional suppliers and reshaping alliances. By prioritizing cheaper oil sources, China is not just cutting costs, it's altering the dynamics of global trade and market sentiment. This shift forces established suppliers to adapt, often slashing prices or revisiting contracts to stay competitive. The impact on Russia, a key OPEC Plus member, is particularly complex. While Russia's discounted crude finds a steady buyer in China, it risks undermining OPEC Plus efforts to stabilize higher global prices, creating tensions within the group. But the implications go far beyond pricing. China's growing partnerships with sanctioned oil producers like Iran and Venezuela represent a strategic pivot that could redefine international relations. By embracing these suppliers, China is signaling its willingness to operate outside the influence of Western norms, consolidating its position as a formidable player in global energy and diplomacy. This approach not only ensures China access to low-cost energy, but also bolsters its leverage on the world stage, paving the way for potentially transformative shifts in both energy markets and geopolitical alignments. Meanwhile, China's long-term energy needs are also evolving, driven by its rapid adoption of electric vehicles, EVs, and renewable energy. As more Chinese consumers embrace EVs and the government accelerates electrification in transport and industry, the country's reliance on oil could gradually diminish. Cleaner alternatives like liquefied natural gas, LNG, are also gaining traction, further diversifying China's energy portfolio and reducing dependence on traditional oil sources. These changes come as China deepens its economic ties with BRICS nations, many of which are major oil producers. Sanctions imposed by Western countries over geopolitical disputes have only strengthened these connections, allowing China to navigate energy markets with greater flexibility. One of the most notable examples is China's deepening partnership with Saudi Arabia, a relationship that has evolved far beyond crude oil. Saudi Arabia has long been one of China's top suppliers, and the numbers tell the story. In 2023, bilateral trade between the two nations hit an impressive $107.23 billion, much of it driven by oil exports. However, this partnership is no longer confined to hydrocarbons. Both nations are heavily investing in renewable energy, aligning their goals as they look toward a greener future. Saudi Arabia's Vision 2030 plan, which aims to diversify its energy mix with a 50% renewable target, has found strong support from Chinese companies. For instance, in August 2024, China Energy Engineering inked a $972 million deal to build a 2-gigawatt solar power plant in Saudi Arabia, collaborating with key players like the Public Investment Fund and ACWA Power. Similarly, in July 2024, China's Sungrow Power Supply joined forces with Saudi Arabia's Al Jihas Holding to develop an energy storage project with a capacity of up to 7.8 gigawatt-hours, enhancing the stability of Saudi Arabia's power grid. The financial ties between the two countries are also deepening. In November 2024, China selected Riyadh as the venue for its first US dollar sovereign bond sale in 3 years, planning to issue up to $2 billion in debt. This move reflects China's support for Saudi Arabia's Vision 2030 initiative and underscores the growing economic synergy between these two nations. Taken together, these developments illustrate a monumental shift in how China approaches energy and global trade. By aligning with non-Western suppliers, investing in renewables, and strengthening ties with key partners like Saudi Arabia, China is redefining its role in the global energy landscape. As these strategies unfold, the implications for global markets and international relations are profound, marking the beginning of a new chapter in energy and diplomacy. If you are still watching this video, it means you love it. Why not take out a second and hit that like button? In the wake of Russia's annexation of Crimea in 2014, Western nations imposed sweeping sanctions targeting crucial sectors of the Russian economy, including finance, energy, and defense. These measures marked a turning point for Russia, prompting a strategic pivot towards the east. The aim? To strengthen economic and political ties with Asia-Pacific countries, particularly China. This eastward shift gained momentum following the escalation of the Russia-Ukraine conflict, which led to even harsher sanctions designed to isolate Russia economically. In response, Russia began offering its vast energy resources, especially crude oil, at heavily discounted rates to China, cementing their growing partnership. By 2023, trade between the two nations soared to a record $240 billion, with energy exports forming the backbone of this relationship. This cooperation expanded further in 2024 with the completion of the Power of Siberia gas pipeline, which significantly boosted China's access to Russian natural gas. The pipeline is part of China's broader strategy to diversify its energy sources and secure long-term supply. Discussions are also underway for the proposed Power of Siberia 2 pipeline, which would redirect gas previously destined for Europe to meet China's growing demand. China's relationship with Iran offers a parallel narrative shaped by global sanctions. Despite US-led efforts to curb Iranian oil exports, China continues to import Iranian crude, often at discounted prices. This arrangement provides China with affordable energy, while giving Iran a critical revenue stream, albeit under tight sanctions aimed at limiting its missile programs and other activities. Similarly, China's energy trade with the United Arab Emirates, UAE, has grown rapidly, reflecting a robust partnership in both traditional and renewable energy sectors. In 2022 alone, the UAE exported $17.4 billion worth of crude petroleum and $4.12 billion in petroleum gas to China. By 2023, bilateral trade between the two nations had climbed to $95 billion, with non-oil trade contributing $83 billion, a 7.5% increase from the previous year. Both nations are now aiming to double their trade volume to $200 billion by 2030. This thriving relationship has been underpinned by strategic partnerships. Through the Belt and Road Initiative, Chinese energy giants like the China National Petroleum Corporation, CNPC, have collaborated extensively with Abu Dhabi National Oil Company, ADNO Aztarchi. For instance, in July 2024, the China National Offshore Oil Company, CNOOC, signed a strategic agreement with ADNOC to deepen cooperation in oil and gas exploration, production, and trade, including liquefied natural gas, LNG. Beyond fossil fuels, both countries are making strides in renewable energy. China's expertise in solar technology has facilitated the export of solar modules to the Middle East, supporting the UAE's ambitious renewable energy goals. These partnerships not only bolster China's energy security, but also advance its broader geopolitical strategy. By forging closer ties with Russia, Iran, and the UAE, China is actively reducing its reliance on Western energy markets and shielding itself from diplomatic pressures. This approach aligns seamlessly with its Belt and Road Initiative, aimed at expanding China's global influence through trade and infrastructure development. The ripple effects of these shifts are being felt in the US energy sector. China's preference for cheaper crude from sanctioned suppliers has reduced its reliance on US-sourced oil. For American producers, this could mean surplus oil in domestic markets, potentially leading to lower prices and reduced revenue. In turn, this scenario could dampen investments, curtail job creation, and widen the US trade deficit. Mounting geopolitical tensions between the US and China, marked by tariffs and trade barriers, have further fueled China's determination to diversify its energy sources, solidifying its pivot away from American crude. China's changing oil import trends reflect its dramatic transformation over the past 4 decades. Once a net exporter in the early 1980s, China has grown into the world's largest importer of crude oil. This shift is a testament to the country's rapid industrialization, strategic energy policies, and growing geopolitical influence. As China continues to recalibrate its energy partnerships and expand its global reach, the implications for international markets and diplomatic relations are profound, signaling an era of significant change in the global energy landscape. The early 1990s marked a pivotal moment in China's energy trajectory. In 1993, the nation transitioned from being a net exporter to a net importer of oil, driven by sweeping economic reforms and a booming manufacturing sector that drastically increased domestic energy consumption. Local production, even from massive fields like Daking, couldn't keep pace with the surging demand. This shortfall set the stage for China to turn to international markets, initially sourcing oil from nearby Southeast Asia. Fast forward to the early 2000s, and China's energy needs exploded. Its entry into the World Trade Organization in 2001 and an unprecedented economic boom fueled by rapid industrialization and infrastructure development saw oil imports climb steadily. By the end of that decade, China's daily imports had surpassed 4 million barrels, supported by major investments in pipelines and refineries that prepared the nation to handle even greater inflows. The 2010s solidified China's dominance in the global oil market. By 2017, it had overtaken the United States as the world's largest crude importer, driven by robust industrial activity and a growing consumer market. The diversification of its supply chain also gained momentum, reducing dependence on Middle Eastern oil through increased purchases from Russia and African nations. By the close of the decade, imports had reached a staggering 10 million barrels per day, underscoring China's central role in global energy markets. Even the turmoil of the 2020 pandemic, which disrupted economies worldwide, did little to derail China's oil imports. Strategic stockpiling during price collapses helped maintain an average of 11 million barrels per day. As the economy rebounded, imports peaked at 11.3 million barrels daily in 2023, despite demand fluctuations tied to lingering COVID-19 effects. Yet alongside this rebound came a significant shift in China's energy strategy, marked by a reduced reliance on US oil and a growing focus on partnerships within the BRICS bloc, particularly with Russia and Iran. This strategic pivot is not just about securing energy, it reflects China's broader geopolitical recalibration. By prioritizing ties with BRICS nations, China is reinforcing its commitment to a multipolar global order. The sanctions imposed on Russia following the Ukraine conflict opened the door for China to purchase discounted Russian crude, strengthening these alliances. Simultaneously, China has expanded its oil imports from Iran, further diversifying its supply base. These moves not only bolster China's energy security, but also reduce its vulnerability to US trade policies and geopolitical tensions. Economically, the benefits for China are clear. Discounted oil from Russia and other BRICS partners allows it to meet its energy demands more cost-effectively. Additionally, these transactions often explore alternatives to the US dollar, challenging the petrodollar system that has long underpinned American economic power. By engaging in non-dollar trade, China and its partners are laying the groundwork for financial systems that could weaken the dollar's dominance on the global stage. For the United States, the repercussions of this shift are significant. Historically, China has been a major buyer of US crude, and a decline in Chinese demand could disrupt the domestic oil market. Oversupply might lead to falling prices, squeezing profit margins for American oil producers, and potentially curbing investment and job creation across the energy sector. This downturn could ripple through related industries like transportation and refining, amplifying the economic impact. On the geopolitical front, the consequences are equally stark. As China deepens its energy ties with BRICS nations, it strengthens an alternative economic framework that challenges US-led systems. This growing alignment could accelerate efforts to reduce reliance on the dollar, undermining a critical lever of US global influence. Furthermore, diminished Chinese demand for American crude would widen the US trade deficit, eroding one of the few areas of significant bilateral engagement. Amid rising tensions between Washington and Beijing, these developments paint a picture of shifting power dynamics in both energy and diplomacy. By recalibrating its energy partnerships and aligning with like-minded allies, China is not only securing its energy future, but also positioning itself as a key player in shaping a new global order, one where US influence faces growing challenges. If you loved this video, be sure to like and subscribe.